My name is Brad Stumpy. I'm a partner and the practice leader for financial institution compliance and loan review services at Anders. I'll be joined today by Sadie Carrera and Sandra Lane, both of whom are former bankers, specialize in loan compliance, and have decades of experience in the industry. Before we get too far into this, I want to point out that if you'd like to download the materials, there's a link to the slides in the chat. We'll also send them out with a recording, but if you want them sooner, so now, head on over to the chat. At the conclusion of each webinar, we ask what topics you would like to see in future presentations, and CRA is always near the top. But we were waiting for the new rule to come out before putting something together. Some questioned whether we should still cover this topic given the legal challenges. We decided to proceed since at the very least, this gives us an idea of what the regulations or the regulators are thinking so that you can begin taking that into consideration in your strategic planning. I'm sure by now everyone is familiar with the number 1,480, which is the number of pages, including the preamble and the new rule. Without a question, there would be no way to cover that much material in an hour. So we decided to focus on one area that would be applicable to banks of all sizes and landed on the retail lending test, which is mandatory for large and intermediate banks and optional for small banks. By the time we got done putting this together, we again thought, there is no way we can cover this much in an hour, but we'll do our best. We've skinnied it down, picked out what we think are the major points, and we'll discuss those at a high level this morning. There's a lot of math, and you'll probably scratch your head a couple times. I know that I did. Due to the volume of material, we may not be able to respond to many, if any, questions. Sandy is in the Q&A, so please submit your questions through the Q&A feature and not through the chat. What we don't get to during the presentation, we'll do our best to answer in the post-webinar materials. So let's go ahead and advance the slides before I ramble on and consume the entire hour with the intro, which I could do. So we've designed this session so that you will hopefully walk away with a basic understanding of the retail lending test. While this only takes up a little over 9 pages in the final rule, nearly 235 pages of the preamble are dedicated to the test. And Appendix A, which walks through all of the calculations, is nearly 40 pages long. So we're shooting for a basic understanding of 250 to 300 pages in an hour's time. From there, hopefully you can begin to think strategically about how this will impact your bank and how you can begin communicating these concepts and anticipating impacts to bank leadership. Whereas the current or legacy rule lends itself to a great deal of subjectivity, the new rule is based in math. Everything is weighted, from product lines to how much consideration performance in a given assessment area affects the rating, to whether lending in low-income census tracts or moderate-income census tracts has a greater impact on the rating. So you, as the compliance or CRA officer, will have a lot of educating to do with the leadership of your bank. So why do we care about this? Here at Anders, our client base is primarily community banks. And the more that all areas of a local community thrive and flourish, the more that community banks thrive and flourish. So maybe a mix of altruism sprinkled in with some selfishness, but knowing community bankers the way I have for 30 plus years, I'm going to say it is primarily altruism. If you're familiar with the rule, you're more likely to achieve your desired rating, whether that be satisfactory or outstanding, so that you can focus on the business of banking, which includes serving your local communities and not spend inordinate amounts of time on remedial action. CRA performance evaluations continue to be public documents, so maintaining that satisfactory or outstanding rating also helps to avoid any potential negative press that accompanies a rating of needs to improve or substantial noncompliance. And of course, as with the current or legacy rule, when you're ready for branch expansion or a merger or acquisition opportunity presents itself, your CRA rating will be one less hurdle, or at least less of a hurdle in that process. So here are the 5 broad areas that we'll discuss today. Sadie will jump in momentarily to cover the first 2, and then I'll be back to discuss the retail lending volume screen and the distribution analyses. Once I have thoroughly confused you, Sadie will be back to close things out by covering the requirements that were supposed to go in effect next Monday on April 1st. They played the good kind of early April Fool's joke on us. You probably saw the notice last week that these changes have been pushed back, but Sadie will let you know all about it. So Sadie, the floor is all yours.
Thank you, Brad. Good morning. I'm Sadie Carrera, Compliance Manager at Anders CPAs and Advisors. I'm going to start off talking today a bit about the bank classification system. The modernization rule retained the three basic categories of small, intermediate, and large banks, with the only change to the naming conventions being that intermediate is now just intermediate, not intermediate small. First, some good news. The more significant change is that the dollar thresholds for each of these classifications has increased. Everybody gives that a thumbs up. The not so good news is that the fact that the increases do not go into effect until January 1st, 2026, which many of you are waiting for, so that's a thumbs down. On the next few slides, I will cover these new dollar thresholds and classifications. Okay, small banks. Many of you are wondering just where will my institution fall come January 1st, 2026. We will start with small banks. The small bank threshold is increasing from its current level of less than 391 million in total assets to less than 600 million assets. Hopefully some of you who are currently intermediate banks can fall back into that comfort zone of a small bank. Small banks will want to familiarize themselves with the retail lending test because they can either continue under the current or what we're going to refer to today as the legacy rule under that evaluation framework, or you can opt into the retail lending test. It's a good idea that you become familiar with both and then make an informed decision on which system that your institution would perform best under. Now keep in mind, the retail lending test will constitute for the entirety of a small bank's rating for those who opt into the new evaluation methodology. Maybe your institution falls into the next category on the next slide of intermediate banks. The low side asset threshold for intermediate banks is increasing to mirror that change for small banks, so assets of at least 600 million. And the high side threshold is increasing from less than 1.564 billion in assets to less than 2 billion. Now, just as under the legacy rule, you have to surpass the low threshold of 600 million as of the last 2-year ends. For intermediate banks, the retail lending test will account for 50% of the overall rating. And if the institution wants to achieve an overall rating of satisfactory or outstanding, then that retail lending test must be rated at least low satisfactory, both of which are similar criteria to the legacy rule. Now, how does the new rule impact the large bank category? The large bank threshold is being raised from total assets of 1.564 billion or more to 2 billion or more in assets, with the retail lending test accounting for 40% of the overall rating. And a similar caveat as for intermediate banks, in that the retail lending test rating must be at least low satisfactory in order to get that overall rating of satisfactory or outstanding. Also keep in mind that large banks with 10 or more assessment areas cannot achieve a satisfactory or outstanding rating at the state, multi-state MSA, or institution level unless 60% or more of its assessment areas have at least low satisfactory rating at the corresponding level. This provision only counts facility-based assessment areas during your first examination underneath the new rule, but will include both facility-based and retail lending assessment areas during subsequent exams. So those of you who have participated in these webinars in the past know that we like to throw out a couple polls here or there, and it helps us learn a little bit about the participants. So we very much appreciate that you're participating, and it's time for our first poll. So do you represent a small, intermediate, or large bank? So your choices are, of course, small, intermediate, or large, And some of you might be on the same path as many I've heard from, and you may just want to choose none. Once I've heard about this rule, I'm going in for retirement. Well, let's see the results here. Let's see. I'm not seeing any results here.
We've got about 9% at small, 30% at
great.
intermediate, and 53% at large, with 6% getting ready to retire.
There we go. Well, we like that, huh? All right. Moving on to the next slide. We are going to we are not going to get into the woods on this next group of slides. That's the assessment and geographic areas. However, it is important that you're at least familiar with these terms throughout the discussion. So when it comes to the retail lending test, there are 3 potential types of geographic areas that can be evaluated, as you'll see on the next few slides. We have the facility-based assessment areas, retail lending assessment areas, and the outside retail lending areas. Now, 2 of these are referred to as an assessment area. Of course, the facility-based assessment area, which closely resembles the assessment area that we're used to under the legacy rule, and the retail lending assessment area. But we have a third, which is referred to as an outside retail lending area, or ORLA. So a little bit about the facility-based assessment areas. The rules for the facility-based assessment areas are not exactly the same as the current assessment areas, but they are pretty darn close. These will include your physical locations and deposit-taking remote service facilities. So we want to think ATMs, interactive teller machines or ITMs, virtual teller machines, VTMs. Facility-based assessment areas must consist of a single MSA, 1 or more contiguous counties within an MSA, or 1 or more contiguous counties within a non-metropolitan area of state. The new facility-based assessment area rule limits the assessment area to a single MSA. The legacy rule permits an assessment area to include 1 or more MSAs, so as long as those MSAs are contiguous. Now, with our Midwestern community bank client base, we don't see multi-MSAs assessment areas, but in some more populous areas of the country, they do exist. So if a bank has multiple MSAs and a single assessment area, come January 1st, 2026, those will need to be separated into separate assessment areas, assuming the bank has a branch or deposit-taking remote service facility within each MSA. Large banks must now include entire counties, while intermediate and small banks can use partial counties, but still must take entire contiguous census tracts. The rule also stands that facility-based assessment areas may not reflect illegal discrimination and may not arbitrarily exclude low or moderate income tracts, or LMI tracts. So for example, if your assessment area comes right up to an LMI or majority minority census tract, you should be ready to explain why that makes sense. If you go 20 miles from your nearest branch in the direction of a high income, low minority tract and stop after 2 miles in the direction of an LMI or majority minority tract, may want to give that one some thought. That may be hard to explain. We move on to the retail lending assessment areas. The next slide will include some information about that assessment area. It's applicable to large banks only, not required if greater than 80% of the lending occurs in facility-based assessment areas, and includes an MSA or non-MSA areas of a state with at least 150 closed-end home mortgage loans or 400 small business loans originated in each of the prior 2 calendar years. So you only need to worry about these if you are a large bank. Those of you that are smaller intermediate banks, you get to breathe a sigh of relief. You're off the hook. Retail lending assessment areas come into play when 80% or less of the large bank's retail lending occurs within its facility-based assessment areas during, again, the prior 2 calendar years, and when the lending thresholds in that final bullet point are met. The 80% threshold within the facility-based assessment areas is calculated based on an average of number and dollar volume of loans. Again, this only applies to large banks. Lastly, let's move on to the outside retail lending areas, or again, ORLAs. This acronym is really catching some traction in the industry, so we're going to refer to it as ORLAs. ORLAs are evaluated for large banks and certain smaller intermediate banks. Some small banks must opt into the retail lending test before they have to worry about ORLAs. For intermediate banks and for small banks that do choose the opt-in option for that retail lending test, ORLAs will be evaluated automatically if 50% of retail loans are originated or purchased outside of facility-based assessment areas, and again, each of the 2 past calendar years. Absent that, ORLAs will be evaluated at the bank's option. So as an intermediate bank or small bank, if you think your lending performance in your ORLAs looks better than in your facility-based assessment areas, think about opting in, particularly if you think that will help make a difference in your overall rating. Now, this slide includes the geographic requirements for ORLAs. While they are nationwide, they will be evaluated as component areas and separate MSAs or non-metro areas of a state. Nationwide area excluding facility-based and retail lending assessment areas, any county and a non-metropolitan area in which the bank did not purchase or originate any applicable loans, and the component areas are metropolitan statistical areas, non-metropolitan areas of a state. Now I'm going to step aside for a bit while Brad explains the retail volume lending screen and walks us through all that math he was talking about earlier that's involved with the distribution analyses. Brad, back to you.
All right, thanks, Sadie. Appreciate that. The retail lending volume screen, maybe it's the beginning of or the continuation of new vocabulary. There's a lot of new terms here. We'll become familiar with them. But the retail lending volume screen is the first of 2 sets of metrics that are included in the retail lending test. The retail lending volume screen measures the volume of a bank's retail lending relative to its deposit base in a facility-based assessment area and compares that ratio to a retail volume threshold that is based on an aggregate ratio for all CRA and HMDA reporting banks with at least 1 branch in that same facility-based assessment area. So if you're currently a smaller intermediate bank, this will kind of be like your current loan to deposit ratio analysis, just on steroids and with a lot more math mixed in. So listed on this slide are the 5 types of loans to include in the bank volume metric calculation. Home mortgages include both closed and open-end loans. Small business and small farm loans retain the call report definitions until 1071 data becomes available, whenever that might be. So 1071. Now there's the newest 4-letter word in compliance, don't you think? So automobile loans, these are applicable for you if they are a product line for the bank, which means they account for over 50% of the retail lending in that facility-based assessment area, or you have elected to have automobile loans evaluated. So here's where the math starts to kick in. So hopefully everybody's buckled up. As I just mentioned, I've heard this referred to as the new loan to deposit ratio analysis, but with a major spin on it. So first, you break the numbers down by facility-based assessment area, and then instead of including the outstanding balance of all loans in that assessment area, like you would in a traditional loan to deposit calculation, you only include the dollar amount of volume metric loans. So remember, volume metric loans are the 4 or 5 loan types on the previous slide that were originated or purchased during the evaluation period. For deposits, you'll use the sum of the annual amount of deposits assigned to facilities within the assessment area based on the FDIC's summary of deposits for that year. Unless your total assets exceed 10 billion, then you'll be reporting separate deposit information under CRA that will be used. So since you are only using a subset of your loans, but all deposits, your bank volume metric will be significantly lower than your traditional loan to deposit ratio. I know, confusing. So to hopefully provide a little clarity, we've included an example from Appendix A on this slide. I'm assuming you have a 3-year evaluation period. The first column on the top of this slide shows the total dollar amount of volumetric loans that were originated or purchased in the facility-based assessment area during each year of the evaluation period. So I know the numbers here are unrealistically low and unrealistically consistent, but this is just an example to show the math. The second column on the top of this slide shows the dollar volume of deposits attributed to facilities within the facility-based assessment area during each year of the evaluation period. To calculate the bank's volume metric, simply, now that's a word you're not going to hear very often when it comes to the new CRA, but simply divide the sum of the volumetric loans by the sum of the deposits, and voila. In this example, the bank volume metric is 20%. Okay, so the first step of the retail lending test is to compare your bank volume metric to a market volume benchmark. Again, there are a lot of new terms to learn. It's confusing now, but by 2026, we'll all be conversant in them. So similar to the current evaluation procedures, where examiners compare your average quarterly net loan to deposit ratio for small and intermediate banks to local peers, under the new rule, they'll compare your bank volume metric to a benchmark that consists of all large bank CRA reporters or HMDA reporters that operated a facility within the assessment area being evaluated that was also included in the FDIC's summary of deposits data for that year. If you're like me, you're thinking, how in the world am I going to come up with the market volume benchmark to see where I stand? That would be a full-time job in itself if you have very many facility-based assessment areas. It's my understanding that the agencies plan to come out with a tool to help you calculate that. So hopefully that is the case. So continuing with our example where the bank volume metric was 20%, we would have met or surpassed the retail lending volume threshold listed here of 12%, which is a good thing. You're automatically eligible to receive a satisfactory or outstanding rating in that facility-based assessment area if the distribution analysis supports such a rating. Factors that can be considered if the bank volume metric does not meet or surpass the retail lending volume threshold are the bank's business strategy, safety and soundness limitations, institutional capacity and constraints. That's going to include the bank's financial condition, the presence or lack of other lenders in the assessment area, a dollar volume of non-automobile consumer loans, and then the catch-all, any other factors that limit the bank's ability to lend in the assessment area. So after considering these factors, if the examiners determine that the bank has an acceptable basis for not meeting the retail lending volume threshold, then the retail lending volume screen will not prevent the bank from receiving a satisfactory or better rating for that facility-based assessment area. If, on the other hand, the examiners determine that there is not an acceptable basis for not meeting the retail lending volume threshold, then large banks will receive either a needs to improve or substantial non-compliance for that facility-based assessment area. The outcome is less definitive for small and intermediate banks, for which the agencies will qualitatively consider the results of the retail lending volume screen when developing their conclusion. All right, poll number 2. How familiar are you with the new rule? A, very familiar. I studied it front to back. B, somewhat familiar. I've read a little or attended a webinar before today. C, not familiar. I know changes are coming, but don't know what they are. Or D, CR what? My boss told me I was the new CRA officer and signed me up for this webinar. So let's see where we're going. So it looks like most of you are somewhat familiar, a few not familiar, and then a couple very familiar. Good. I may lean on you for some help. Or CR what? Very good. All right. We do appreciate everybody participating in the polls. So next up is the distribution analysis. This is the new term for what we used to call geographic distribution and borrower profile. As with the current or legacy rule, we'll compare the bank's performance to demographic data, which is now referred to as the community benchmark, and aggregate data, which is now referred to as the market benchmark. A big difference is that under the new modernization rule, there are specific thresholds that must be met to achieve various ratings. These thresholds are a specific percentage of either the community or market benchmark, and we'll get into those details in a minute. Another difference is that everything is weighted. So if your evaluation includes home loans and small business loans, each will be weighted according to their proportion of the evaluated loans within each assessment area. When you get to how much weight does a particular assessment area count towards the overall rating, that will be weighted by an average of loans and deposits attributed to that assessment area. So you roll that up into ratings for MSAs, states, and ultimately the overall rating, and each is weighting according to the proportion of loans and deposits at whatever level you happen to be assigning ratings. So a lot more math, a lot less subjectivity. Another thing to keep in mind is that these new evaluation standards do not become effective until January 1st, 2026. But the agencies have said that 2026 evals will in all likelihood not be performed using these standards. Rumblings are likely 2027 at the earliest, then maybe not until 2026 aggregate data becomes available. We shall see. All right, on this slide, we have the 4 potential product lines that may be evaluated in each geographic area. And when we refer to a geographic area, in this case, we're talking about a facility-based assessment area or an outside retail lending area, an ORLA. For a retail lending assessment area, your 2 potential product lines are closed-end home mortgages and small business loans. Again, small farms, small business loans continue with their call report-based definitions until 1071 data becomes available. Automobile loans count if the bank is a majority automobile lender or elects to have automobile loans evaluated. To determine which product lines will be evaluated in any given facility-based assessment area or outside retail lending area, you'll determine what percent each individual product line represents of total retail loan originations and purchases during the evaluation period by both number and dollar volume of loans. You then average the percent by number and the percent by dollar volume for each product line. If the average of the percent by number and percent by dollar volume is 15% or more, then that product line will be evaluated within that facility-based assessment area or the ORLA. It can be different for each assessment area and each ORLA. For automobile loans, though, the average must be 50% or more, or the bank must opt in to having automobile loans evaluated. So if you have a retail lending assessment area, the 15% calculation does not apply, but the thresholds that Sadie covered earlier and that are repeated here based on the number of loans is what will carry the day. Remember also that this only applies to large banks as they're the only ones with retail lending assessment areas. The geographic distribution analysis outlined here is a similar concept to what we are used to. Bank metrics are the percentage of bank loans in a certain area, say low-income census tracts. Community benchmarks, again, are demographic information, and market benchmarks are analogous to aggregate data or what other lenders are doing. The borrower distribution categories are also similar to what we see in the current borrower profile analysis. One difference, particularly for small and intermediate banks, is the stratification for gross annual revenues as it relates to small businesses and small farms. Many performance evaluations today just look at GAR, gross annual revenues, of $1 million or less. Under the new rule, those businesses or farms with gross annual revenues of $250,000 or less are analogous to a low-income borrower, and those with GAR of more than $250,000 up to $1 million are analogous to moderate income borrowers. So this is the beginning of what I referred to earlier as being, in my mind, one of the more significant changes from the current lending test. Under the current rules, the ranges above or below demographic and aggregate data that result in a certain rating, they're inconsistent. And in many cases, they're very broad. More often than not, that seems to work in banks' favor, as there are usually various factors that impact loan distribution during a given period of time. And examiners are usually open to those explanations. Even if they press you for information to back up your theories, that's their job. Sometimes they're pressing you even to the point that you're sweating bullets up into the exit meeting. If you've done your homework, you've got your facts straight, it usually turns out okay. So to arrive at a threshold for a given rating, you multiply the community benchmark by the community multiplier to reach a calibrated community benchmark. You then do the same thing for the market benchmark. The threshold is then the lower of the two calibrated benchmarks. So are your eyes spinning in opposite directions yet? I know that mine were the first couple times that I read through this. So we have an example for you on the next slide. Here you can see the calculation in action. So this example shows what it would take to achieve a preliminary rating of outstanding for a particular criteria in a particular geographic area. This same method works for the geographic distribution analysis or the borrower distribution analysis. So for discussion's sake, let's just assume this is for home loans to moderate income borrowers. This table shows that 12% of home loans made by all lenders in the geographic area were to moderate income borrowers. And from the previous slide, we know that the calibrated market benchmark for outstanding is 15% above the actual market benchmark. So we calculate 115% of 12% and arrive at a calibrated market benchmark of 13.8%. So the bottom row shows that 16% of families in the geographic area are moderate income. And from the previous slide, we know that the calibrated community benchmark for outstanding is 100% of the actual benchmark. So that's math even I can do in my head. 100% of 16% is 16%. We then compare the two calibrated benchmarks, 13.8 for market and 16 for community. And the lowest of these two values, 13.8%, is the threshold to achieve an outstanding rating for that test. So put simply, at least 13.8% of your home loans during the evaluation year must be to moderate income borrowers to achieve a preliminary rating of outstanding. If your level of home loans to moderate income borrowers is less than that, then you will need to calculate the thresholds for high satisfactory, low satisfactory, and so on until you find where your bank's performance lies. So walk through all of your tests for each loan type being evaluated and for each year of the evaluation. Loans to low-income borrowers, loans to businesses and farms with gross annual revenues of $250K or less, loans to moderate income borrowers, loans to businesses and farms with GAR greater than 250 up to $1 million, loans in low-income census tracts, loans in moderate income census tracts. It's a lot of calculations. So keep in mind that if automobile loans happen to be a product line for your bank, there will not be a market benchmark. So you'll only be using the community benchmark for automobile loans. All right, next slide. All right, once that is done, you'll assign a performance rating to each of those tests. And from that conclusion, you'll assign a performance score. So in the example we just went through, if your bank's level of home loans to moderate income borrowers was 13.8% or more, home loans to these borrowers would receive a performance score of 10, corresponding to outstanding. You'll compute that score in 4 different categories, 2 each for geographic and borrower distribution for each of the major product lines to come up with your product line scores, which we have demonstrated on the next slide. So assume we've went through all of the analyses to come up with our performance scores for lending in low-income census tracts and moderate income tracts, as well as to low-income borrowers and moderate income borrowers. You'll have a table that looks something like this. If we were evaluating small business or small farm loans, then instead of low and moderate income borrowers, you'd have gross annual revenues of 250 or less, and then from greater than 250 up to $1 million. So you can see that the analysis is much more formalized and structured than under the current system. Under the current system, we would have probably eyeballed the raw data, said, well, yeah, it looks pretty good for lending in low-income census tracts and the low-income borrowers, but it's a little light in moderate income tracts, even more so to moderate income borrowers. So we'll split the difference, call it satisfactory. Under the new system, not only do we have specific numbers and metrics to use, we then take this one step further and weight each of these factors so that we come up with a weighted average before arriving at a final product line score. So, are you ready to see how that works? All right. As I'm kind of reading through this, I know the opening paragraph here might be a little, maybe even a lot confusing, but the weighting factor for each distribution analysis is based on community or demographic data. The example on this slide is for the geographic distribution of home loans. So essentially, to compute the weighting factors for loans in low-income census tracts versus moderate income tracts, you'll take the percentage of owner-occupied housing units, the community data, in low-income census tracts over the total percentage of owner-occupied housing units in both low and moderate income tracts. So the total is your denominator, and the percentage in either low or moderate income tracts is your numerator. So for a simple math, or as my kids call it, dad math example, let's assume that in the geographic area being evaluated, there are 100 owner-occupied housing units in LMI census tracts. 40 of those are in low-income tracts, and 60 are in moderate-income tracts. That would give us a 40% weighting factor for lending in low-income tracts and a 60% weighting factor in moderate-income tracts. So this slide explains how you apply the same concept for small business, small farm, and automobile loans. Which piece of demographic information do you use? For small businesses, it's the percentage of businesses in low-income tracts or moderate as compared to the total percentage of businesses in both low and moderate income tracts. For small farm loans, you just substitute farms for businesses. And then for automobile loans, the demographic you're looking at is the number of households in low and moderate income tracts. And for borrower distribution, again, it's the same concept. Notice that you're looking at families for home loans and households for automobile loans. For CRA evaluations, you just need to be sure you're selecting the appropriate benchmark. But in case you're curious about the difference, a household can be one person or multiple unrelated persons living in a single housing unit. A family is 2 or more people related by birth, marriage, or adoption who reside in the same housing unit. This slide demonstrates how to calculate the risk weighting factors. It's a tongue twister. Let's stick with the example of geographic distribution of closed-end home mortgage loans. Let's assume that 4% of the owner-occupied housing units in our assessment area, can also be in ORLA, are in low-income census tracts, and 16% are in moderate income tracts. So we add 4 and 16% to come up with our denominator of 20. 4 divided by 20 is 20%, and 16 divided by 20 is 80%. And that gives us our weighting factors. So next, we need to apply these weighting factors to the performance scores for each of these analyses. And this slide demonstrates how to implement these risk weighting factors and continues with our previous example where we had an outstanding for geographic distribution of home loans in low-income tracts. That gave us a performance score of 10 and a low satisfactory for geographic distribution of home loans in moderate income tracts for a performance score of 6. So multiply our low income tract performance score of 10 by the 20% weighting factor to arrive at a low income weighted score of 2. Repeat that calculation for moderate income tracts, you get a weighted score of 4.8. Add these two together for a product line score of 6.8, which equates to a low satisfactory. So recall that you need to score 7 to be considered high satisfactory. So under the current system, it's likely that we would have said this factor was high satisfactory, splitting the difference between outstanding and low income tracts and low satisfactory in moderate income tracts. However, since the new rule more heavily weights the performance in moderate income tracts, because that's where more of the owner occupied housing units are located, we end up with an overall rating for the geographic distribution of home loans in this area of low satisfactory. So then to determine the product line score for closed-end home mortgages in this particular assessment area, we averaged the geographic distribution weighted score of 6.8 that we just calculated with the borrower distribution weighted score of 5.3. So trust me on that one. We don't have time to go through each and every calculation. So we average those and we arrive at a product line score of 6.05, which corresponds to a low satisfactory. So it's not unheard of, particularly in non-metropolitan areas, to have an assessment area with no lower moderate income census tracts. In those instances, the borrower distribution score will serve as the overall product line score. But once we go through this exercise for each of the major product lines in the geographic area, we're ready to begin calculating the retail lending test area score. So let's assume that the geographic area we're evaluating has two major product lines: closed-end home mortgage loans and small business loans. And we've went through both the borrower and geographic distribution analysis for each. Now we need to determine how much weight to give to the home loans versus the business loans. To do this, you total all of the major product lines for that geographic area. It could be up to 4. Here we only have 2, by both number of loans and by dollar volume of loans. Next, compute the percentage of each major product line by number and dollar volume. So here, home loans account for 40% of the number of loans and 66.7% of the dollar volume of loans. Small business loans account for 60% by number and 33.3% by dollar volume. So finally, average the two percentages for each product line. So for home loans, that average is 53.35%. And for business loans, the average is 46.65. Those are your weighting factors for each of the two major product lines being evaluated. So now that we have the product line scores and the weighting for each product line, we're ready to calculate the retail lending test score for this geographic area. You've probably guessed what's next. We will multiply the product line score by the weighting factor to arrive at the weighted score, and then add the weighted product line scores to arrive at the area score. Did I say it was a lot of math? So this table shows the closed-end home mortgage loan score of 6.05 that we calculated before, and then assume small business loan score of 5.2, for which we did not walk through the calculation. So multiply these product line scores by the weighting factors to arrive at the weighted scores, and then add the weighted scores to arrive at your retail lending test area score of 5.66. So don't start flipping back to see what rating corresponds to an area score of 5.66. Those were product line performance scores we saw before. The ranges for area scores are different than for product line scores. I know, confusing. We've got those on the next slide. So drum roll, please. A retail lending test area score of 5.66 corresponds to a low satisfactory. So for this geographic area, the recommended conclusion is low satisfactory. The recommended conclusion, that's what you arrive at using the math as the recommended conclusion, that is considered along with additional factors and other performance context information to arrive at a final conclusion. So we still have performance context. So you can find the additional factors included on this slide and the next in section 22G of the reg if you want to read more. We're running close on time, so I'm not going to dive into each of these in detail, but any one or a combination of these could be used to either upgrade or downgrade a recommended retail lending test area rating arrived at using the mathematics that we just walked through. I do want to point out the first one, though. The word inappropriately is in quotation marks here because it is taken straight from the text of the regulation. That section includes examples of inappropriate enhancement as information indicating subsequent resale of loans or any indication that such loans have been considered in multiple depository institutions' CRA evaluations. So if the examiners come to this conclusion, then the loans in question may not be considered in your performance evaluation. The factor I want to point out on this slide is the first one, and it's also one that we run into occasionally with a bank that has a low volume branch. It's geographically distant from other branches. Oftentimes it was part of an acquisition, was not the reason for the acquisition. It's the only branch in that assessment area. You know, one way or the other, if there are that few loans, the weighting factor for this assessment area would be very low and likely have a minimal impact on the overall rating anyway. So in addition to these factors that are directly from the retail lending test section of the reg 22, the concept of performance context remains, and section 21D is in delta of the reg lists specific performance context information that can be considered. And here we have the beginning of those. So capacity and constraints can include the size and financial condition of the bank, as well as any safety and soundness limitations. Demographic and other relevant data will be information such as income levels and distribution, the nature of housing stock, housing costs, economic climate. You're familiar with those. The fourth bullet on this slide is likely going to come from community contacts and what they're saying about how the retail banking and community development needs are being met by local banks. And here are the final three performance context categories. Notice the final catch-all of any other information deemed relevant by the supervisory agency. So while the recommended rating arrived at via the math can be adjusted by these additional or performance context factors, my expectation, based on nothing other than my gut, is that these adjustments will be the exception rather than the rule. You'll probably need a strong argument to make an adjustment. So we're getting close. You've calculated the recommended conclusion for the geographic area. You've reviewed any additional factors and performance context information that may impact that conclusion, and you've assigned a conclusion or rating for that geographic area. Next, you assign a numerical factor to that conclusion, and we have that chart on the next slide, I believe. Yes, we do. This goes back to the same 10-point scale that we saw earlier when assigning scores for geographic and borrower distribution analyses. So continuing with our example, we would assign a performance score of 6 to this area corresponding to low satisfactory. The final step then is to aggregate the ratings for all geographic areas, assign a weighting factor to each, and calculate an overall retail lending test conclusion for the bank. So this is done by rolling up the ratings on a statewide and multi-state MSA basis, then an institutional basis similar to how it's done today. The weighting factor is based on the average of that area's share of deposits and share of loans. So we've got an example for you, believe it or not, on the next slide. So for this example, which essentially comes from Appendix A to the regulation. So Appendix A is where you can see examples of all these calculations. Well, let's assume that the bank operates in one state where it has 2 facility-based assessment areas, 1 retail lending assessment area, and an ORLA. If the bank operated in multiple states, then we would not factor the ORLA in at the state level. We'd wait until we were performing the calculation at the institution level before we'd include it. To arrive at the proportion of deposits, you sum the total of deposits for each area for each year in the evaluation period. So if there were 3 years, you would add all 3 of those years together for each area, then sum the totals for each area and determine your percentages. Similarly, for loans, you add the total of all of the major product lines in that state for each area for all 3 years, sum the totals for each area, and determine your percentages. Then you take the average of the proportion of deposits and the proportion of loans for each area, and that is your weighting factor. So for example, in facility-based assessment area number 1, the average of 15% for deposits and 20% for loans is 17.5%. So let's assume that the example we've been working through is facility-based assessment area number 1, which was a low SAT. So we assign 6 points to that. Multiply 6 times the weighting factor of 0.175 and arrive at an area score of 1.05. We do the same thing for the other 3 areas in the state and then sum all of the area scores to reach our recommended institution retail lending area rating, which is a mouthful. So these 4 area scores total 6.265. To see what rating that corresponds to, we go back to the same chart that we used when determining the score for a geographic area, and we have repeated that on the next slide. There we go. For the state, and in this example for the institution, since we only operate in one state, a performance score of 6.265 corresponds to low satisfactory. If this bank operated in multiple states, we would have omitted the ORLA from the statewide calculation, performed this exercise for each state in multi-state MSA, and then repeated the exercise, substituting the different states, Missouri, Illinois, so on, multi-state MSA, St. Louis, for the various assessment areas, and also adding in the ORLA at that point. So just as with each geographic area, at this point, you could also adjust the rating for additional factors in performance context. Reiterating a point from the beginning of the presentation, the retail lending test accounts for 40% of the overall rating for large banks, 50% for intermediate banks, and in both instances, a minimum retail lending test rating of low SAT is required to receive an overall rating of satisfactory or outstanding. Small banks, if you opt in, it's your entire rating. So that is about all I have left in me. You probably had enough of me a long time ago. So I'll go ahead now and turn it back over to Sadie to wrap things up. Just want to say thank you very, very much for spending an hour with us this morning. We do truly appreciate that.
Thanks, Brad. Okay, we had originally planned to wrap up the webinar with the requirements that were going to go into effect next week on April 1st. However, on March 21st, the Fed released that these were delayed until January 2026. So a little April Fool's joke played on us, huh? But we get to sigh another sigh of relief, so that's good. So on this next slide, I was going to cover a few of the most important changes. I'm not going to go over the first one, but the second one, we have received a lot of questions about the availability of the public file on the website. So we were going to tell everyone, yes, it's time to get it out there. But if you don't have it out there yet, again, you have until January 1st, 2026. If you already have it out there, it's your choice. You can leave it out there. You can take it down. It's up to you. Now, we've covered a lot of ground today. We've covered the bank classification system, assessment in geographic areas, the retail lending volume screen, and all the information from the distribution analyses, which we hope all will be useful to take back to your institution for some additional thought and planning. And of course, now we all have just a little bit more time before implementation. Now, there's a lot more to this new rule, and we've only dipped our toes in the pool of it. So we've included some links on the next slide that are to CRA pages for each of the federal agencies. And as always, we like to hear about what you'd like to see in future webinars. We do these about quarterly, so we can plan to hold the next one in late June, and we will start sending out invitations about a month ahead. So this poll is a little different. It's a word cloud to see what topics you'd like for us to cover in future webinars. We've had a pretty good response to these sessions so far. So again, we plan on doing these quarterly. So please let us know what you'd like to see. Is it going to be more CRA, BSA, fair lending? Oh, and here we go. We've got about 4 responses. Oh, CRA is kind of taking the lead there. That's awfully big for us, huh? Assessment areas, fair lending, all kinds of. Oh, that looks great. That's great. CRA seems to be taking the lead, though, as it should, right? There is a lot of information there. So I know that several of you have been with us for all 4 webinars, so we really appreciate you hanging in there with us while we try to iron out the wrinkles and just get it a little bit better for you each time. If you want to view any of our previous webinars, head on over to our website at www.anderscpa.com. Then you'll click on Industries, select Banking and Financial Institutions, and you'll scroll all the way down to the bottom of the page where you'll find Insights, and you can check out our webinars there. Again, I think CRA definitely took the top spot. Now we just have one additional poll. It's the very last one. Again, this is a word cloud, but this will not be broadcast for everyone to see, okay? This last poll, we'd like to know where you've heard about this webinar. Was it social media, maybe email invite, or maybe you're a member of an association in the area and you heard from it. Or maybe it was just frankly word of mouth from your favorite auditor here at Anders. If you would, please let us know. Now, if there were any questions that you left in the Q&A today that were not answered, we will get back to you on those. We just needed to take a little bit of time to do some research. We do have one quick question I believe Brad has time to answer, so I'm going to just bow out for a second and let him answer the question.
All right, thanks, Sadie. We just had one question submitted, and I don't have a great answer for you, but the question is, I may be going into the weeds here. Do the owners of deposits have to be located in the facility-based assessment area? For example, out-of-area deposits are booked to the branch that was contacted for the deposit. So I'll have to tell you on this, I don't know. It would go by however you report that on the FDIC summary of deposits. Those rules would govern it, that I'm not familiar enough with them to answer that. We'll take a look and see if we can put that out with the follow-up materials. And that's the only question we received, other than will there be a video sent out? And yes, there will be. So that's all I have. Sadie, I'll let you wrap it up then.
All right, great. Yes, we will send out a video recording of this webinar to all the participants, whether or not you actually are on the video today. If you registered, you will get a copy of that. So we will close with a couple of slides that have contact information for Brad and myself. And as always, feel free to be in touch with either of us at any time. We are happy to help with any of your institution's needs. And we really thank you for joining us today. We hope you found this useful and hope that you have a fabulous rest of your week. Thank you.